What are stocks? A stock, also known as equity, is a security representing the ownership of a fractional portion of an issuing company. Shares are called units of stock, and each share entitles the owner to receive a proportional amount of the issuing company's assets and profits. Stocks are bought and traded primarily on stock exchanges and are used as investments by individuals and institutions alike. Understanding stocks. Corporates issue stock to raise funds for operating their business, and the holder of stock, a shareholder, may have a claim to share in the company's assets and income. A shareholder is considered an owner of the issuing company, based on the number of shares owned relative to the total number of outstanding shares. For example, if a company has 1,000 outstanding shares and one person owns 100 of those shares, then that person owns 10% of the company's assets. Shareholders do not own a company, rather, companies are a special type of entity because the law treats them like legal persons. Companies file tax returns. They can borrow money, own property, and be sued. The idea of a corporation being a person means that the corporation owns all of its assets. A corporate headquarters filled with desks and chairs belong to the corporation, not to the shareholders. Property belonging to the corporation is legally separate from the property of shareholders. If the corporation goes broke, a judge may order the sale of all of its assets, but the assets of shareholders are not at risk. If a major shareholder goes broke, he or she cannot sell the company's assets to pay his or her creditors. Shares give owners the right to vote in annual shareholder meetings, receive dividends when they're paid, and the right to buy back their shares from someone else. If you own a majority stake in a company, you have increased influence over how the company operates. You can appoint the board of directors, who hire professional managers to run the company. Ordinary shareholders do no management.